The 100 pips a day Forex trading strategy is brought to you by mmforex.com. What I am sharing with you today is a system of trading that is both simple and manageable. You see, in my 12 plus years of currency trading, I have seen every system, indicator, robot, and marketing gimmick there is out there. In all that time, I've found that the keys to trading successfully and consistently are to truly understand price action, have a solid, simple trading plan, and to have proper money management. There are only two things that you can count on in the Forex. There will always be a high and a low of the day on every pair, and that the numbers in the Forex price action software are golden. We look to identify the high and the low of the day through a confluence of events with these special number price points and then trade back into the daily range for a goal of 50 pips. With a 100 pips a day strategy, we don't care where a pair will be in 2 days, next week, or next month. We only care what it'll do tomorrow. We look to trade off of the high or the low of the day back into the range for a goal of 50 pips. We look for only 2 trades per day. We're looking for a confluence of events to set up in the Forex price action software to identify a reversal point. The goal of this strategy is to learn how to identify the correct entry point at the correct time of the day for the highest probability of success. These setups do not happen every day on every pair, but they do happen often enough over a basket of 6 to 9 pairs that you can make a great living if you are patient. 50 trades of 50 pips with a 20 pip stop risking 2% of your account would grow your account very fast. But first, a warning to you. The Forex is highly manipulated. What the retail trader does not know is that the Forex is highly manipulated for the benefit of a select few. The 10 biggest banks in the world provide 80% of the capital used to provide the liquidity in the Forex on a daily basis. They entrust their money to specially trained market manipulators to manipulate the price action of all Forex pairs on a daily basis. They use this capital to manipulate the price action to take your money. This small elite group of market manipulators control how the Forex plays out on any given day. What I'm about to share with you boils down to this. These manipulations are visible on the chart to the trained eye. Once you see the movements and understand what they mean, you will be able to trade profitably. The truth is that the movement in the Forex is not random. The Forex moves in a well-defined mathematical formula. There are a special number of price points that contain price action on a daily, weekly, or a monthly basis. The market manipulators that work for the big banks use these hidden price points to reverse price action when you least expect it. These numbers have never been revealed before in any Forex software until now. These numbers have nothing to do with Fibonacci, MACD, pivot points, or any other technical indicator being used by the retail traders. Knowing where these secret reversal points exist on any chart is a big key to your success. Why the 100 pips a day strategy? Because 80% of the time the Forex pairs are not trending, they are oscillating. Mostly in the summertime or during times of low volatility, during these times, trend following does not work. So you start with a 20 pip stop and you risk 2% of your account and you take a 50 pip take profit per trade. You can see that you start with a $5,000 account, you risk 2% of your account, you have a 20 pip stop loss per trade, and you've got a 50 pip goal. You start with a $5,000 balance. After your first trade, your profit goal is $250. 50 trades, 50 pips, your account balance has grown to $54,606. If you get good at this strategy, you can reduce your stop loss to 15 pips. And the same $5,000 would grow to $118,134. Will you win every trade? Of course not. Even the biggest and the best traders in the world have losing trades. With this strategy, you do not have to take every trade. You want to learn how to take every trade right. Learn how to manage a losing trade. If the trade is going against you, you close the trade with a very tight stop loss. You save your equity to trade another session. With a 100 pips a day Forex strategy, every day on every pair, we'll find that we have a high and a low of the day. Our goal is to identify the high or the low of the day through a confluence of events and then trade back into the zone for a goal of 50 pips. I find that the best chance of catching the high or the low of the day is in the New York session, as the pairs will always end the day off of the high or the low of the day. This is the typical Forex daily cycle. We had 120 pips of movement from the high and the low of the day, but it only closed 20 pips below the start of the day. Step 1. At 5 o'clock Eastern Standard Time, the high and the low of the day are reset. The price comes in, and the market manipulators make a quick push up 15 to 25 pips. They may make a quick pull back down, and then they go sideways. Then they move it again for 15 to 25 pips. Why does this happen? Because when they drive it up, you buy, and then they sell to you. When they drive it down, you're a seller, and they'll buy it from you. They're collecting contracts and they're building up the positions. For example, say there's $500 million in long holders and $200 million in short sellers. Well, guess who's getting hammered today? It's the long holders. It's simple. It has nothing to do with the look at the daily or the weekly charts or what the other technical indicators are telling you. It's how many positions they hold on either side of the range of the start of the day. It's all about what side of the trade has the most money built up and how they can make the most money by stopping the traders out of the trades. Sometime then between 1 a.m. and Eastern Standard Time and 4 a.m., they'll break out of the Asian range in 3 or 4 quick movements on a 15-minute chart. They'll quickly hit the high of the day, pull back, and work it for 30 to 90 minutes. They begin trapping more long holders and collecting positions against them. Quickly pushing out of the Asian range will trigger the stops of the traders that are short. The brokers see these positions on their platform and they stop hunt them. They hit the stop losses and they get the confused traders to recommit their funds long. So let's say half the short sellers come back in and $500 million has now become $700 million long. What's the goal of the market manipulators now? To get that money. And how do they do that? There are a lot of people that trade off of retail technical indicators. Since they lag, they are slow to respond. The dealers know this. Most traders rely on these tools to try to make a trading decision and lose sight of what the candles are actually telling them. The job of the market manipulators is to get you to commit your funds long and to trap you so that they can reverse the movement and take your equity. To the untrained eye, candles on a naked chart are confusing. You never know beforehand what a pair may reverse on you. They will then quickly pull back off the high of the day, trapping all of the long holders, and they will hold the level. Then after 60 or 90 minutes of consolidation, they will start the trend run against the original move. Once they set the high of the day off of the break, they'll start the channel and they'll run the trend down for 6 to 8 hours. Have you ever taken a trade and felt so excited that you were confident that it was going to go your way and that you started counting your profits beforehand? You go and you take a break and you come back to the computer and you were stopped out. Or worse, down big. You had no stop loss and you feel sick to your stomach. You ask yourself, what just happened? Unknown to the retail traders, the dealers use computer programs based on special price points that are hidden in plain sight to trap the traders that do not know that they are there. Did you think that the big banks and dealers trade with indicators? No, they trade with the numbers. The job of the manipulators is then to get you to commit your funds short and trap you again so that you can reverse the price movement and take your equity. But when you see the special number lines in the quarters theory indicator, they make sense. Then between 8:30 and 10:30 Eastern Standard Time, they will make some sort of reversal pattern, double tops or double bottoms. They'll pull it quickly off of the low, go back into consolidation to end the day 25 to 50 pips off of the low, then start the process again the next day. Once you understand how they do this and you use these special numbers to trade with, you will have the confidence to place your trade. You set your stops behind these special number price points for added security. The numbers don't lie. How would you know where these formations would occur without the numbers from the quarters theory indicator? Would you rather add a bunch of squiggly lines and worthless indicators that take your eye off of what is most important? Price action? Or be certain, the numbers don't lie. The number sequence from the quarters theory indicator shows you where a pair may reverse and helps you to be prepared. However, now you know better. You can take advantage of the move by trading like a Forex dealer and not a retail trader. You anticipate the move, you wait for it, and enter very close to the high or the low of the day for 50 pips, minimum. Your stop will be placed 20 pips above the high or below the low of the day and behind one of these special number price points. Just take short positions at the high of the day or long positions once the low is established. Your stop loss for short trades is placed just above one of the special numbers and above the high of the day. or below the low of the day for long trades. If you're correct in your assessment, your stop will rarely be triggered because a dealer will not move the entire market just to hit your stop. Understanding this cycle gives you a major edge in your trading. Once you can identify it on a chart, taking trades is simple, second nature even. Just initiate short positions once the high is set for the day or long positions once the low is established. Your stop loss for short trades is placed just outside the dealer's grasp above the high, or for long trades below the low. This is an example. The Asian accumulation session, the pair spiked up to one of the small numbers in the quarters theory indicator. You initiate a sell position, you got an easy 50 pips. Another example, out of the Asian session, they made a stop hunt low right against one of the hesitation zone numbers in the quarters theory indicator. The pair rose for over 130 pips. Another example, spiked to the low during the start of the London session, right against one of the numbers, the hesitation zone, and the pair rose. In this example, the pair consolidated during the Asian range. It made several quick swipes to the high, right up at the box where it says the London gap. Just sold that spot with a 15 pip stop loss, and the pair dropped for an easy 50 pips. Here's another example where the pair came out of the first blue box, which is the Asian range. It spiked up quickly right up to the hesitation zone at 184.25 from the quarters theory indicator. Could have put a stop loss, sold the pair at that point and put a stop loss right above that hesitation zone, and the pair dropped for over 230 pips. Another example, came out of the Asian range, the first blue box. It spiked up right up against the large quarter point at 1.6000, and the pair dropped for over 260 pips. In this example, the first box, the blue box, is the Asian accumulation range. Pair spiked up right up against the 194.25 hesitation zone from the quarters theory indicator. The pair fell for over 120 pips. In this example, at the end of the previous day, you can see that the low of the day was set, spiked right down to the center point of the quarters theory indicator, and then it cycled up the beginning of the next session, spiked right back down during the Asian session to the hesitation zone at 2.3421, and then it rose for over 377 pips. Remember, the Forex is manipulated. Stop getting ripped off. Use the numbers that control the Forex. Learn what real price action trading is all about. Go back to your charts and see if you can see this pattern. You will see this pattern happens every day in one form or another. In closing, please remember, there is something going on behind your screen. Learn to trade real price action because the Forex moves in a well-defined mathematical formula. Master the 100 pips a day Forex strategy. You use the numbers that rule the Forex because the numbers don't lie.